Do you want a financially secure future, not just for yourself, but for your loved ones as well? This is Generations of Wealth, the podcast that breaks down the most effective wealth building strategies you can easily apply to your own life. Join investor and international best-selling author Derek Dombeck in exploring practical tips and sound advice on building a profitable business, creating a powerful brand, or getting into the thriving world of real estate investing. This is your chance to create your very own financial roadmap to live your vision, love your life. Let's begin this discussion with your host, Derek Dombeck.
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck. And before we introduce our guest today, which is going to be a really fun show, he's got a bunch of experience. He's been in this market since 2006, actually. So I love interviewing people that have, 20 plus years experience. But I want to talk to you a little bit up front about Elite Negotiations Academy, which we've launched. And what this is, twice a month, I'm going to take recorded negotiation phone calls, or it could be kitchen table conversations that were recorded from our members or from myself, and we're gonna pick them apart, and we're gonna talk about what could be done different, how to talk to people, how to lead that negotiation to the outcome that you want, and it's really awesome. So if that's something that you think can help you, go to elitenegotiationsacademy.com. Also, the REI Circle of Trust has got some openings. So if you're looking for a real estate investor mastermind like no other, where we get together twice a year in person, we stay in a house together, you're immersed with your group, go check out REI Circle of Trust, and it's reicot.com. And give us a little feedback on yourself. I'll interview you and talk to you about what we do. So with that, I'm really excited to bring on Charles Carillo. Like I mentioned, he's been in multifamily for many, many years. Now he does syndications, whereas he started out house hacking when he first started. And just a great interview. Can't wait to bring him. So let's just do it. And with no further ado, Mr. Charles Carillo. Charles, thank you so much for giving us some of your time. And why don't you tell the audience a little bit about who you are and where you come from?
Yeah, well, thank you so much for having me on today. It's great to be here. I'm originally from Connecticut, a small town in Connecticut, and I've been down in Florida, where I am now in southeast Florida, Palm Beach area, since 2012. But originally, I began investing in multifamily real estate in 2006, and there was not really a term back then, but now it's called house hacking, and that's what I was doing. I was living on one floor, renting out the other two, and then a couple of years later, I did that in '08. Completely different times of buying property. It was the end of '08, literally like 2 weeks after I closed on that second property, like 2 weeks after Lehman went under. So it was, and like a month before like Madoff. So like every time you turned on any type of news, it was just like something else went out of business, someone else isn't lending. You know what I mean? And it was a crazy time. And then like about a year or so later, I bought my first commercial property and kind of went from there. And it was, I built this small kind of portfolio of properties over the 6 years. I moved to Florida in 2012. I put like professional management in place of it, held it for like 10 years, and I sold them all to a investor out of New York in early 2022. But since 2018, our firm has been involved with syndications down here in Florida. So purchasing larger apartment complexes with investors in Florida, throughout the central Florida, and then also with a couple different teams we have in Dallas and then also in Atlanta. So that's kind of what we've been up to over the last few years.
Well, that's great. I got a lot of different questions that are going to, I guess we'll start in the beginning and then work our way into the syndication. But when you started in '08, because a lot of people have no idea what to do now as the markets are starting to change. Mm-hmm. And, as we're recording this, we just found out who our president-elect is going to be. And some people are really, really jacked about that, and some people aren't. But that could have a positive effect on markets. I guess time will tell. But specific question, when you bought that property in 2008, did you buy at the top of the market and then your property values went down, or were things already going down when you started buying?
It was already turning into a buyer's market by the time it was, you didn't really see all the blood in the streets, but it was like, it was happening. You know what I mean? And the first property I bought in like end of '06, that was definitely at the top of the market. But at the end of '08, that property, it was a much better property. I paid a little bit more for it, but it was just a much better property. I kept tenants in there longer. It was literally like a block and a half away. But it was something where, it was just bigger. Units were bigger. Everybody stayed longer. I made more money on that property. So I was buying better properties for a similar price, let's just say. But it wasn't like getting into like 2009. When I bought a property at the end of 2009, I think that was like blood in the streets, because I had money from another business and I was investing it, and it was the end of '09, and literally I was finding a property, and the only things that were really moving back then were stuff that was on FHA. So we flipped some properties during that time too, and I flipped some properties with my dad and my brother, and I remember when we were flipping them, you just had to be completely 100% that this thing was going to get FHA financing, or you couldn't do it. You know what I mean? Like it'd be too risky, right? And so you'd see stuff and you're like, I don't know about that stairway. You know what I mean? Like I remember turning down deals because you're like, that stairway doesn't have this. You know what I mean? Kind of stuff here. You're like, nope, not going to do this. Not going to take the chance on it, because if it doesn't get it, I mean, you're just not going to be able to sell it. That was like the only thing that was lending. So you were, some of those properties in that residential were like, were going like that. But when you got up to 5+, it was, five units or more, it was over. There was nothing. And I remember putting in offers on properties that were like 5-6 units, and you could go in like 30%. Some would be on the market for 5 months. You can go in like 30% under, and they're already taking like a half. They've already lost like half what it sold for before. And you go in 30% less, and they would respond to you within hours. You know what I mean? It was like, stuff was not moving, and you could just go in there and kind of name prices and buy stuff just to get stuff off their books. So that was, I think 2009, what I saw was really like the lowest part for the market that I was kind of working in. I think stuff started opening up in 2010 and 11 a little bit, but there still wasn't even lending in like 2010 or 11 for that type of property. I remember going to get I want a commercial property refinanced, and a bank that my family had done business with for many years, I had had a relationship for a few years, they literally were going to give me like a 10 or 15% loan to cost of what, and this thing was kind of like, all rented out, the whole 9 yards, cash flowing, no mortgage. And that's what it was. So it's like, you're not lending, you know what I mean? There was no lending on anything that was happening that was reasonable. Even private lenders were like, oh, I'll lend like half of what the appraisal is, or whatever, whatever the thing was. It was like 30% loan to value. So it was a much different time. And it's just, if you had cash, it was king, you know what I mean? Just like how it usually is in these situations, because, the debt is such a propulsion for people buying real estate.
Well, then that does lead to a burning question of, how did you fund your deals back then?
So the first couple ones I did FHA mortgage for the second one. I did in the end of '08, that was like a conventional mortgage. I put down a larger down payment, and they were fine with that. It wasn't really a problem. It was when you're getting over 5 units. And that's when I would come through. I was putting cash in, and then also I used a private lender that would put some money down. But I mean, it was extremely safe for them, right? It was someone I knew that I had bought a property before, and it was one of their lenders. And so if you were coming in and you had, a sizable down payment, and they would lend it, you know what I mean? But it was one thing that it went longer, you know what I mean? You just had to tell them, hey, they want to do like 1 year on it. You're like, it's not gonna be able to be right for you finance in 1 year. You know what I mean? You had these conversations up front, so then you can go 2 or 3 years on it. So
yeah, absolutely. Primarily, you've always bought based on cash flow, which I love, because there's so many people, especially in the last few years, who got, I think, caught up again in the dream of, well, it's appreciating, so maybe we're not going to make any cash flow, or we'll actually lose money each month, but we'll base it on appreciation, which I hate that model. That model kicked my ass back in the 2000s. And what's your feeling on how should a property cash flow? Do you base it off actual numbers, or are you basing it off cap rates? And I'm sure some of that may have shifted from when you're doing small multis to now large multis.
Yeah, the cap rate game, I mean, you kind of have to, when you're now when you're working with larger apartment complexes, it's all off the cap rate and you're working off the NOI and stuff like this. And it just depends on what people are paying for it. Like I sold some properties. We sold a property in 2023, a C-class property, and I sold it in cap rate like in the high fours. It was extremely like overpaid for that property, that buyer. You know what I mean? But he had other properties in the area and he's probably doing well at whatever he's doing there. You know what I mean? But the thing though is that, how do I know that? When I have a broker that's telling me, oh, it's supposed to be 5.5 or whatever, or 4, you know what I mean? Or I'm working all my numbers on it's 5, and then they're buyers are coming in at 5.5. So it's like, I think that's very difficult. It's with smaller properties is much easier. I find it because if cash flows, you know what your debt is. And those first properties, like getting longer term debt or the ability to go longer on it. Like my first couple properties, those were like 30-year amortizations on those. So going through wasn't a problem. And then I bought property with myself with all cash. It was a smaller property, and then I bought another one with a private lender. So it was like the ability of like having that long-term debt and having some idea of what your interest rate is fixed. And you can do it even with commercial mortgages going to banks, but just don't get it for like 3 years. You know what I mean? Get it like for your 5, 7, 10 years, pay more for it. Know that you're gonna have that prepayment penalty too. I know everybody hates that, but it's something that if you are unsure, those are really the ways. There's really 3 ways I've figured out when I teach people. It's really like, long-term fixed debt, at least, 7, 10 years. It's having the reserve fund and buy stuff that's cash flowing. You know what I mean? With the problem is that they're using expenses from the last, from the seller. You have to use, fresh property taxes and fresh insurance quotes, especially now. I mean, insurance quotes they're all over the place. So it's just like, if you have the debt, insurance, and the taxes kind of like figured out, and you're like pretty sure on what those are going to be. It's difficult at that point, you know what I mean, to have something you're gonna lose money on.
What do you think about all the people, and as we start to talk about syndications, all the people that have syndicated properties and got the 3-year bridge loan, 5-year bridge loans that are now coming due, and they bought at 4% cap rates, and they're not going to cash flow at 7% interest rates?
Yeah.
What do you see? Is that it's obviously opportunity for some of us, but do you think there's going to be blood in the streets?
You always think it depends on what you read and what you're listening to, but I've spoken to syndicators that have had issues. We haven't had any capital calls or anything like that, but when I've spoken to syndicators that have had capital calls and have had loan workouts, the better properties, like your solid B class and above properties, are the ones that I hear are getting workouts from the bank, right? They're getting a little bit more leeway because I think that they're betting on it that when construction and deliveries kind of slows down here over the next 12, 24 months, that they're going to be able to, capture their loan amount, and people are going to be able to walk away, maybe not making much, but they're not really losing. And I think that's kind of a workout. The deals that I've seen that have gone south have been poor quality deals in poorer areas. And you know what I mean? Less ideal neighborhoods and stuff like this. And when you pull them up where they've gone, where they foreclosed, and you look at them, you pull them up on different maps of where we would do our due diligence if we were buying that property. And you're like, oh, anybody that drives by this property is going to be like, well, we're just going to get rid of it now. You know what I mean? It's not, these properties aren't going to come around anytime in the next few years or whatever it might be. And I think those are the properties that are going to be in much difficult positions. People that bought properties that were, your older properties, maybe your CC minus properties or below. I mean, those are, I don't see those really coming back around. People that got bridge, that have workouts with their lenders, that are maintaining their properties, that are keeping their occupancy high, they have a chance. You know what I mean? They have a chance of coming through and working through it, maybe getting a capital call to like shore up stuff. On a couple past investments I've had as in multifamily, I've had some capital calls. And on one of them, they're like in the process of writing, but one of them pretty much righted it. So it's kind of one of those things where, obviously interest rates coming down helps as well, but it's just one of those things that, you have to work out what you're doing to try to, so people don't lose money. You know what I mean? And I think that's one of the most important things. But I think better properties are the ones, and the ones I see struggling in my passive deals and funds I've done are just ones that aren't in the best areas. You know what I mean? They aren't in that area that's really going to have where people want to go. Because right now, people can go anywhere. I mean, it's a renter's market out there. Concessions on brand new stuff for months and months, free moving, free everything, right? Just so they can get that 90% and people can sell the property, those developers. But, as that kind of starts peeling away over the years or two, I mean, we're going to get back to a much more normal market, right? And normal rents.
Yeah, and so obviously that's going to be based on location. Some areas still have, like I'm in Wisconsin, upper Midwest. We don't have people giving concessions to fill their units yet. But obviously where you are in Florida, that's happening, and in other markets it's certainly happening. So as we start talking about syndication, how do you project what your rents are going to be moving forward in your market specifically? Because you've got these brand new construction buildings, they're given concessions, it's going to drive rents down, and now you want to go and buy an existing building or even build new. How do you structure your syndication to mitigate risk and to keep it safe for your investors?
Yeah, that's a great question. And typically in a normal market, if you're you're buying a property that's built in 1990, you're looking at what rent comps are from everything, probably late 80s to where you are, that 1990, not really going over it, and figuring out where rents are. Now you have to take the whole market, kind of like all your comparables, and look at them all, because you might, property built in 1990 years back might not have any issues with something built in 2024. But now, you know what I mean? You're seeing rents that might even be comparable over a year period, where you're getting 2 months for free here, or this or that for free, or whatever it might be, more amenities for sure. And you'll have renters that are jumping there. I think the real idea is figuring out, for what you're doing, work to the property and currently where it is, and seeing exactly, finding true comparables in your area of exactly your same condition right now, and kind of putting that all together. So the way, when you're going through like uncertain markets, what we've done before is that, we have a property that's it's 157 units in Gainesville, Georgia. And before we had, all this, interest rates changing in 2023 and stuff like this, we were doing probably 3 to 5 renovations on turns every month, right? And now that's down to like 1 to 2. It's a little safer. You're making sure that any kind of renovations you're doing, you're going to be able to achieve what you're projecting, or you kind of just start just painting and cleaning and re-renting, kind of a thing. You know what I mean? So I think understanding that, because syndicators as well get into it, and they're like, oh, we're just going to turn everything in like 2 years, and we're going to put $7,000 in every unit, and we're going to get $200 more of rent, or whatever the numbers is they're working on. But when you're getting into markets like this, you need to have that difference in rent between the new deliveries coming on, and it has to be even wider now, because for people to make that decision of staying in your property versus going to that Class A property that has easy underwriting, all amenities, free rent, stuff like this. So I think knowing your comparables of exactly where your condition is now, and understanding exactly what the comparables are, the properties where they're going now, where they're going in the future, and seeing how those are renting. And I think the other thing too is really, everybody brings up like technology and AI, and this is great, but real estate's, you got to really walk the properties. It's like when I would check out new property managers, you walk the properties, like not just like drive by the ones they're managing, but like go into the properties and walk them and see how they look and stuff like that. It's the same thing if you're like mystery shopping your comparables, because you're going to walk in some of them and you're like, whoa, this is not a comparable. You know what I mean? This is much nicer, or this is much, not as nice, right? And comparing that to your property, your subject property you're looking at, is very important. And at this point, it's extremely important, because there's no buffer. In like hot markets, you have the buffer with rents going up. You know what I mean? In hot areas like locations, you have that, and you're like, okay, I can overpay a little bit if rents are going up this much. All the people are moving into it. But when you get into markets like it is now, or stagnant rent, I mean, your numbers have to be right on. It's like when we used to buy, and most of our properties in Central Connecticut were all cash flow properties. There wasn't really appreciation there. So you had to make sure your buy was correct, or you would never make money because there wasn't the appreciation.
Yeah, for sure. You mentioned 1990 a few times. Do you have an age range of where you just will not even look at a property if it's older than?
Yeah, that's great. We sold our last C-class property built pre-85 in 2023. So that was like our last property. That was now we predominantly just do like B-class properties that we're working on. But when we're doing, I've made the decision since I think the last one we bought was 2020, and then we just sold that. So that was I think since like 2020, 2021, we've made the decision of going into properties that are like 1985 or newer. And then there's a number of a few different kind of construction type of materials that we're not going to go into and touch and stuff like that. And because you get older, and as you're getting older, it's one of those things that you're putting a lot of work into the property, and you're fixing a lot of items that are the bones of the property that really aren't raising rents. You know what I mean? And that's one thing where I don't mind doing it, but there has to be the discount, and it has to be like quite the discount to do that, because you're not just disrupting a unit for like 2 weeks, right? Or a month, right? From the time someone moves out to the time that you might have someone looking at it to rent it. I mean, you're doing it for months now. If you're getting into, pulling out walls, changing pipes, stuff like this, plumbing, all that stuff. So you have to be really compensated for it, because it's not just the work that you'd be like, oh, it's going to cost you $5,000 to do this. But, you might not have the unit for 6 weeks, right? Or whatever it might be. So this is something that you have to put that into your numbers too, where it's not just $5,000. It might be now $9,000, right? Because I lose 2 months of rent or whatever it might be. So these are things that people have to put in, and usually you don't see those discounts in many situations.
Yeah, and very few people talk about this. That's why I really wanted to know your answer, because it's like you described earlier. We're just going to have a blanket 2-year time frame and put $7,000 into each unit, but do they really factor in when you do have to open up that wall, or you find out that you've got, bad piping throughout, and now you've got to open up every unit wall in the bathrooms or the kitchens. And so I love the idea of keeping it newer. For myself personally, in the residential space, I like 1975 and newer, and it's primarily because of its conforming sizes for doors and windows and all of that type of stuff. And my markets have a lot of 100-plus-year-old houses, and I get a lot of leads on those types of properties. And typically, if I do put them under contract, I'm going to wholesale them off, because they just take too much time, and there's nothing conforming about it. So it's all custom, and it gets very expensive.
A lot of unknowns too.
A lot of unknowns, definitely. So, are you finding it harder right now in today's economy to raise money for syndications? Have we seen people get burnt? So now they on other syndications, not yours, but people that have gotten burnt, and they did have capital calls, so now they're gun shy and they're holding their cash.
Yeah, a little bit of everything. When I speak to people in our potential kind of investor base, you have a lot of people that lost money. They put multiple deals in with a lot of syndicators multiple times per year, which is kind of like my red flag when I'm investing passively. Is like I won't invest with the same operator twice in 1 year. So it's something that, and obviously don't go over like no more than like 5% of your net worth into any deal. It should be like a little bit less if you have more money. But it's one of those things that if you can maintain that, then you can really limit your downside if anything goes bad. But there's people that were like, yeah, I invested in July 2021 with this person, then September 2021, then, you know what I mean? And it doesn't give you much of a fluctuation of what's happening. And it's amazing. A lot of people that have been in investing, real estate investing for decades, you know what I mean, they've lost their shirt in going through this one. You know what I mean? They bought thousands of units with, like you were saying before, like this ultra low bridge debt. The other thing too I'm finding with syndications is that a lot of the deals I've seen coming across my desk from other operators, they're not true like value add deals. You know what I mean? They're coming through and they've already been renovated to a certain level. And it makes me wonder where the value comes from to show me that you're going to get 18% returns in 5 years, you know what I mean, per year, whatever it is, so I don't see that. And, it's just like, oh, we're raising rents, or we're doing this, or we're going, that's kind of like not the business plan to be working at this part. I want to see, not that I want to get into something where I'm moving walls or like really heavy renovations, but it's also something that there has to be some sort of value you're adding to it, or there's a reason why the person selling it is not raising rents. You know what I mean? And that's not a good sign if you're a potential passive investor looking at a deal. So that's one thing I've seen. But yeah, I mean, a lot of people, and I was talking to another operator about this a couple months back, and he was like, yeah, he's like, we just have to get you have to get like a new investor list. If you're having problems raising money from people that have been burnt before, even from other syndicators, they're not going to return. You have to find new investors. And it might be true. I don't really like that per se, but it's also, you're trying to, all the kind of questions and everything that went through with them, you know what I mean? Negatively. Now you're going to have to, now you're going to have to explain to them why you're different compared to someone that's new to the area, new to what you're doing, and new to this investment class. So it's not making it easier. That's for sure.
Yeah. But I love that because it's a thinning of the herd, right?
Yep.
The cream rises to the top. I love market shifts, and my audience knows that about me because I really enjoy creative real estate deal structuring. I don't typically use institutional funding for anything. So I like to see, I don't like to see people lose money, but I like to see the tire kickers and the wannabes kind of exiting the business. So specifically with your syndications, how do you figure out, the deals or the markets you want to focus on? And because some people don't even really know how a syndication works. Talk about sponsors and operators and a little bit of the basic stuff.
Yeah, so syndications really work off of two different parties. So there's two parties in a syndication. There's the general partners, key principals, operators, sponsors, all these different names that are given to, and everybody in there has like a slightly different role, but really they're the general partners, and they're really running the deal. They're doing everything from locating the market to the properties, to raising money, to closing it, to manage it when it's happening, working with the property manager, to ultimately selling the property down the road. Okay. Then on the other side of the deal, you have the limited partners, passive investors, investors in general, and they are the ones that are funding the whole deal. Now you'll have some of the general partners, and usually, like when we do a deal, usually general partners are putting 20-25% of the money, so they're actually on both sides. So if you're a general partner, you should be on both sides of the transaction. And so you have skin in the game, but also you're doing all the time of doing everything. And that passive investor, once they do their due diligence on the deal, on the sponsor, and their work's pretty much done. They should be getting a monthly communication, possibly a quarterly one from the sponsor. After 6 or 9 months, you'll probably start getting your first distributions depending on the business plan of that property. Usually that's quarterly. And then what happens as well is that you'll get a K1 at the end of the year. So really your work's done after you do your due diligence on the deal and the sponsor, and you wire your funds over. And that's really kind of how the whole process works. Usually it's split in the sense of where you have some sort of preferred return, which is usually about 7%. And that means that these passive investors over here are going to get that 7% every year before profits are shared with those general partners. And then after that 7%, it's usually split somewhere like a 70-30, where 70% above that 7% goes to these passive investors and 30% goes to general partners. And obviously that can be, it's a very simple explanation, but kind of how it shows where these two parties work together. And it's been a model that's worked for hundreds and hundreds of years outside of real estate, but all the way back to the Renaissance. They've been using it to raise money and to it's carried interest. It's being able to cover people with the risk that they're putting in, the capital they're putting up at risk.
But now most syndicators, and I don't know how you do it, most syndicators are raising 20, 30, 40% of the money and then using institutional financing for the bulk of the purchase.
This is something that's happened over the last few years. It's not something we weren't doing this. We did this on one of our deals, but and it's fine working with some sort of mezzanine lender or something like this, a preferred equity lender, and it gives another level of it puts the passive investors one step behind, but it's kind of become a requirement for some certain syndicators that are overpaying for deals to a certain level, right? It's because now you can still show the returns to these investors, these passive investors. You have these limited partners, but you show those returns because you're taking less of their money and you're utilizing a kind of almost in the sense of a second mortgage on the property, let's just say, right? So you have your main senior debts at 65% loan to value. Then you're taking this preferred preferred equity piece. It's maybe like 15% that's going to get paid right after that senior debt. And then you're going to have this last 20%, which is going to be passive investors, which back in, 5-7 years ago, we would raise this whole thing, you know what I mean, from 70% or 65% to 100% ourselves. And it's not something that we've used once before, and I've been on deals with it before as a passive investor, and there's pros and cons to it. Obviously, I mean, you're going to get any kind of passive investor money that's getting put in there is going to get wiped out, you know what I mean, first. And so it's much more dangerous in that sense. But it's kind of one of the things that's had when people are getting into bigger deals, and also deals where the deals aren't as great. You know what I mean? I've seen on some of them, you know what I mean? And it works sometimes when you do it and you get really good returns if you have a really good operator and it's a really good deal. But it can be very dangerous too, because you're just wiped right out. And possibly some of that preferred equity too is going to be wiped out, but they'll come out majority of their money back.
So for clarification, you are raising all of your money without using institutional financing for your syndications?
Yeah, we've done one deal with doing a preferred equity piece, and that was 2022, like mid 2022 when we closed on that property. And it's fine. Or no, that was end of 2022 we did that property. So it was interest rates were already pretty much 4% plus at that point. But it's fine. I mean, it's just one more level of, it was a huge deal. So it was just one more level of complexity that you're working through. But also, somebody might say on the pros or cons of that deal is that you can pause distributions if you want with keeping the property to that preferred equity piece. So that's something they're not going to be the happiest person for that group to work with, but you can pause it if you're really getting into trouble. And say it was you got a higher loan amount or something like this, you're not going to be able to really pause your loans with your lender. So it's something where you can there's, again, like most things, there's pros and cons to it. But I mean, how it's supposed to work is where you're supposed to just elevate these returns for these passive investors where they will take on the risk of doing it. And then for that preferred equity piece that's putting that 10-15% in, coming in like a 65% loan to value to like 80% loan to value, they're getting paid usually like low double digits to be able to, low teens probably, now it's probably mid-teens, for taking that risk where it's not first piece secured. However, they're going to probably it's going to be very difficult for them to lose all their money. You know what I mean? So they're usually secured on that pretty well.
Well, I truly like your model far better than what a lot of syndicators are doing with the institutional debt. I'm a firm believer in dealing with people instead of bank boards and the institutional. You can have a great relationship with that bank, and one person gets fired or decides to leave, and it's gone. So I truly love that. As we kind of start to wind down here, Charles, what's one question I should have asked you that I haven't?
Oh,
and it doesn't have to be about the topic we were talking about, but I like to ask all of my guests this.
Main thing I would say is, I guess, a few different things, I guess, for people that aren't going to buying property safely, you know what I mean, on your first property and securely do it. And I think people, one thing I would say for that, to answer that, would be just buying properties in better areas. And growing up, my dad was a multifamily investor since the time I was born to when I bought my first property. He kind of pushed me into doing it. And he bought really poor area properties, and they were extremely management intensive. And he kind of started taking his own advice when I bought my first house hack. And I found out it was a lot easier to manage. And as you buy properties in better areas, what do you know? People stay there longer. You make more money. It's less hassles. You're dealing with credit tenants, people that actually have credit. You know what I mean? You're not like making a deal every time someone moves in. So don't be scared. I don't want to say pay more for property and be comfortable with it, but there's a difference when you're looking at two different properties and you're like, well, it's much lower per door over here. And this is a mistake all new investors make. You know what I mean? Look at these huge returns over here, high cap rates, everything's great. And then over here, oh, it's lower, blah, blah, you know what I mean? Less units, all this kind of stuff. But then you realize with that, more expensive property, it is going to probably appreciate faster. You're going to have more buyers, more lenders that want to deal with that than dealing with this over here. Because this is going to be a management nightmare. And if they take it over, they never want to take this over. You know what I mean? I find that there's always buyers in good or bad markets for good real estate. You're not going to get the same price you were in that hot market, but there'll be buyers for it. It's much different to unload your C- property or D property in a bad market.
Yeah, absolutely. Absolutely. Well, we're going to have a link for everybody to be able to contact you at thegenerationsofwealth.com/Charles. But what can my audience do to help you?
Yeah, if you're interested in learning more about what we're doing, our company's Harborside Partners, and with Harborside Partners, if you go there, we have a wealth of information. I have a YouTube channel, podcast. We have a free investor guide if you're a passive investor. I also do some one-on-one coaching for active investors if that's what you want to be doing, and you can find all that information right on our website. So it'd be great. And if you're interested in passively investing with us, set up a call with myself or someone else on the team by going through our form there. And looking forward to speaking with you.
Awesome. Like I said, that's thegenerationsofwealth.com/Charles. Really easy to remember. And man, again, I appreciate you taking the time, giving us your feedback. I always enjoy talking with people that have been in the game for 20 plus years because we have seen market shifts, and we can help the audience based off of some of the lumps that we've taken. So yes. Thank you very much, Charles.
Thank you so much for having me on today.
Well, with that, everybody that's a regular, you know the deal. Please go out, share this with anybody you possibly can. Help grow the Generations of Wealth community. Give us all the likes, the loves, the 5-star reviews that you possibly can. And if you just found us, welcome. We appreciate you being here. Until the next show, go out and live your vision and love your life. See ya.
Thank you for joining us on another insightful episode of Generations of Wealth. May your newfound knowledge help you in leveling up your own strategies to get through the many obstacles to your money-making processes and bring you much closer to the financially secure life you truly deserve. Continue filling up your accounts and further polish your financial tactics by listening to more episodes of the podcast at thegenerationsofwealth.com. Because in your wealth-building journey, there is no other way to go but up, giving you the chance to finally live your vision, love your life. That's all for now. See you on the next one.